Group, and I'll be delivering today's presentation, Recent Trends in Retirement Plan Fee Structures, kind of the outgrowth of our annual 2014 fee benchmarking study. I'll start with a couple of just general housekeeping items. Your lines have been muted to try and make the audio quality better. However, if you have questions throughout today's presentation, you'll see in the GoToWebinar tool there is a question and answer box. If you want to forward those as we go through, I'll take as many as I can as we go through the presentation. At the end, I'll try and get any stragglers that I may have missed, and to the extent that I can't get them all in the 60 minutes we've got allotted, we'll certainly follow up with responses. As I mentioned, my name is Eric Daly. I'm Managing Principal for the Multnomah Group. And I'm eager to kind of work through today's topic. I think that it has some interesting practical applications at the plan sponsor level. I'll also add as another housekeeping item that we are recording today's presentation. So to the extent that you don't get an opportunity to take notes or you'd like to review some of today's content, at the conclusion, we will be sending the recorded presentation as well as a copy of the slides, as well as a copy of the white paper that reviews our findings from the 2014 fee benchmarking study that we conducted. What I'm going to talk about a little bit is our annual survey. So on an annual basis, we go out to the marketplace and benchmark the fees that are being paid by our clients versus what they would be able to attain if they had to take their plan out to bid. Clearly, most plan sponsors don't like the disruption, the cost and effort associated with having to do vendor searches. So the study allows us to figure out whether our clients have fallen out of what we would consider to be competitive benchmarking range, which gives us the ability then to go back to the extent that the clients are happy with the services that they're receiving from their service provider and renegotiate the fee burden. When we do that, we're really benchmarking the fees associated with 4 critical services. Record keeping, so maintenance of defined contribution account balances and trading records for participants. Administration, which tends to be the technical filing aspects of defined contribution plans. Custody, the actual possession of plan assets, and the employee communication process. Because that employee communication process for many of our clients tends to come from the service provider on the record keeping and administration side. What we had really seen since we started this study back in 2010 was a tremendous amount of fee compression. When we released our 2013 study, we'd seen almost a 20% decline in defined contribution pricing, which led obviously to the question, well, how is it possible that in a business that already has relatively tight margins, many of the folks that are consultants here have worked in the record-keeping administration business in a prior life and recall how difficult that work is, how is it possible that we've seen such continual reductions in price? Well, the primary reason has to do with the growth in plan assets. Over that same period of time, 2010 to 2013, we saw a 29% increase in defined contribution assets. So that's coming out of obviously the 2008-2009 decline. But that 29% increase in DC assets is material because so much of retirement plan pricing on the defined contribution side continues to be oriented towards asset-based fees. So while the asset-based fee may not have changed or potentially even has declined from 2010 to 2013, the asset pool on which that fee is being assessed or charged has increased at a more rapid rate. So that allows for some revenue growth despite the fact that the number that many plan sponsors pay attention to, which is that asset-based fee number, may have been on the decline. Interestingly, in 2014, we didn't see material changes. The reductions we saw were in very specific large average account balance, large mega plans. We didn't see a tremendous amount of movement in the smaller plan marketplace. And as we took a look at the factors that led to the fee compression, It's interesting. It's certainly been many and varied. Maybe the first and most important is that we've seen a significant reduction in the number of defined contribution record keepers and service providers. Callan Associates report had 40 such record keepers on a national basis back in 2006, and that had declined to 27 by 2014. So that's a pretty material contraction in the marketplace. Typically, when you see contraction like that, you'd see an increase in fees, less competitive availability. However, in the record-keeping space, so much of the costs are associated and charged across a large participant base or asset base. So to be competitive from a fee perspective, you need to be a large provider with a large volume of assets and participants that enables you to ultimately drive down the costs that are being charged to plan sponsors and in some cases to plan participants. Over the same point in time, the Department of Labor has been very, very focused on trying to help illuminate fee structures. So back in 2009, we saw the birth of a much enhanced Schedule C in the Form 5500 filing that was intended to help plan sponsors get greater visibility about who was being paid out of plan assets and in what manner they were being paid. And then in 2012, we had 408B2 covered service provider annual fee disclosures. So notices that covered service providers needed to provide to plan sponsors that, again, articulated how they were compensated. At the same time, we had 404A5, the annual participant fee disclosure notice. So we can make significant arguments about whether plan sponsors and plan participants specifically have grown to understand the 408B2 and 404A5 participant fee disclosure notices. However, I don't think it can be argued that plan providers haven't been responsive. I think that this illumination, whether plan sponsors and plan participants understood it or not, has served to try and drive down prices as providers are much more sensitive about the numbers that they're reporting on those two documents. Simultaneously, we've seen increased legal action on the fee side. I think this has been brewing for some time, but over this same period of time, we've seen certainly legal course action on Tibble v. Edison, which had to do significantly with fees, on Tussey ABB, which had significant fee components, on Billowitz FMR or Fidelity, which had significant fee components. So all three of those cases and a dozen others that are in the courts currently provide a significant highlight opportunity to demonstrate the potential liabilities associated with not managing fees well, and therefore leading to fee compression. I think that as you look at the various legal cases, what we've asserted for some time and continue to assert is that from a fiduciary breach perspective, it is arguably the most important area of emphasis, and I think that is because A, it's the easiest to prove. If there are various share classes or cost structures that could have been achieved differently and you failed to achieve them, it's easy to prove that, and it's certainly easy to quantify that. Very, very different than trying to assert that investment product A was unsuitable and would have generated a better return had you selected investment product B. So as a result, I think this will continue to be an area ripe for additional legal activity going forward. There's also been increased audit activity from the U.S. Department of Labor. If you look at their 2014 fact sheet, they had nearly $600 million in recoveries last year. They had nearly 4,000 civil investigations with a tremendous amount of financial results and 365 criminal investigations with over 100 indictments. So audit activity from the Department of Labor, which is the primary entity concerned with these fee issues, continues to be on the increase. It's been on the increase from 2010 through 2014, and I don't see much evidence that that would slow down at some point in 2015 or in the foreseeable future. And in addition to all these, we've also had a lot of noise from a media perspective as well. Back in 2013, a professor at Yale sent out thousands of letters to plan sponsors based on a project he had conducted to audit 5500 filings notifying plan sponsors that they were paying too much for their retirement plan. Clearly that's not an enforcement action, but the amount of attention it received from all plan sponsors, and certainly importantly from those that received the letter, served to, again, highlight and drive this issue of fee compression. And even this last week, there was a leaked White House internal memo that discussed the amount of money being siphoned off the private retirement system from brokers who are collecting commissions off retirement plans. So internal documents like that, again, receive a fair amount of attention and could serve as a highlight for what may be future areas of inquiry going forward for the Department of Labor and the Employee Benefit Security Administration. This is one of my favorite slides because I think it highlights, it's very difficult to explain conceptually retirement plan fees, but I think this actually does an excellent job. It's from the ICI, highlighting how retirement plans are paid for. So as you look at our financial study results, what we're focused on is that upper right-hand corner, the record-keeping retirement service provider. How are they compensated? And significant portion of overall compensation still in that marketplace comes from the bottom right-hand corner, investment providers, who are providing investment products through defined contribution, and they're paying some portion of their expense ratio back to the record keeper for providing those record keeping and administrative expenses. So like most entities, anytime you have a party serving between the service provider and he or she who is receiving that service, it creates a fair amount of complexity and can hide in many cases how fees are being paid and gives you less control over managing that fee expense. One of the things we're going to talk about is the reduction in the emphasis of using investment providers or investment products to pay record keeping fees, and instead using direct forms of payment, whether it's from the employer to the record keeper or whether it's from the participant to the record keeper, where disclosure is much simpler, negotiation is much more clear, and some of the complexities of the current pricing arrangements can be driven out of the system. So as we look at 2014, it became clear that the issue that plan sponsors were talking about and that plan providers are thinking about is not, can we drive prices down? I think that will continue to some degree or another as the market becomes more efficient, technology becomes better. However, the issue that was on everyone's mind seems to be fee fairness. So who is paying fees, and are those fees and those who are paying fees being assessed in a fair and reasonable manner? You know, the first question that pops up is, should participants be paying expenses or sponsors be paying expenses? And this isn't a fiduciary decision. Frankly, every plan from the settlor perspective has the ability to make a determination as to whether the sponsor should pay record keeping and administration fees, the participant should pay record keeping and administration fees, or whether some combination would be most fair and appropriate. The question that's come up frequently recently is, are asset-based fees really the most appropriate way to pay for record keeping, administration, employee communication services? Is that a good tie to the amount of work or effort that's being extended in the marketplace, or should a per capita or per head fee, would that be a more appropriate way for record keeping expenses to be assessed? Is it fair and reasonable that different participants who hold different investment products may pay a larger or less large percentage of record keeping expenses? So if product A has a lot of revenue sharing, product B has no revenue sharing, then product A is really generating the revenue or income for the record keeper, despite the fact that that may be a byproduct of their asset allocation methodology and not their preference to pay expenses for record keeping administration. And we've seen a huge proliferation in the last 24 months. They've been around for a long time, but the increase in the utilization of these accounts in the last 24 months has been astonishing. these plan expense reimbursement accounts, or ERISA accounts, quote unquote, where service providers take revenues in excess of their revenue target and contribute those to the plan, or agree to pay reasonable expenses from those excess revenues. And is that a fair and reasonable methodology to pay for expenses that are permitted by the Department of Labor? So as we went through our study, we saw there were really 4 trends. 2 that I would say are the service provider side, and 2 that are on the plan sponsor side. On the plan sponsor side, what we saw was a significant increase in the utilization of what I'll call fee equalization type methodologies. And I'll explain that in greater detail, but essentially it's making sure that every investment product contributes equally to whatever the record-keeping administration expense may be. The second is a strong movement away from asset-based structures to per capita fee structures. So tying expenses to ultimately the number of participants rather than tying it to the size or the pool of assets within the plan. On the service provider side, the amount of compression we've seen certainly has not gone without notice on the record keeper provider side. We have seen a significant increase in the utilization of transaction and process fees as a method to assess additional revenue streams outside the primary numbers that the plan sponsor marketplace is negotiating with their providers. And the last one, and I think this one will continue to be the case, I think for good or for bad, the marketplace is moving this way pretty quickly. With the compression in margins on record-keeping, administration, employee communication services, we will arrive at a point, at some point, perhaps in the near future, where the only service providers left on a national basis will be those service providers who can generate other streams of revenue and income from retirement service business. And we'll talk about some of the plays and some of the ways that they can do that. But if the average cost of record-keeping administration is $80 per account holding participant, a plan with 200 participants therefore is only generating about $16,000 in revenue a year. That doesn't pay for a lot of in-person service, education, filing, the risk associated with managing the plans to begin with. Therefore, plan sponsors will be looking for other cross-sell opportunities that will increase revenue in other areas that the plan sponsor is less focused on. Let me start on the fee equalization. We wrote a white paper on this. You certainly can access it on our website. Amy Barber did a nice job in our office of kind of explaining the trend that we're seeing here. But on the fee equalization side, as I mentioned earlier, plan record-keeping administration fees are often offset either in whole or in part by revenue sharing payments, payments that are made by the investment products to the record-keeping administration service provider for providing this level of record-keeping administration employee communication. And the notion here being that if I opened an account, me as an individual participant at Fidelity, and my IRA account had 10 holdings in it, Fidelity would be responsible for record-keeping that. If I went to a TPA firm here in town as part of a 401k plan, and me and 300 other people own those same 10 funds, Fidelity, for their part, only has to worry about one account, not 300 accounts. And therefore, a portion of the expenses Fidelity is willing to provide to the record keeper for providing that record-keeping administration service. The challenge with that model is primarily that there is no consensus about revenue sharing payments. So they vary dramatically among investment products, among investment providers, among investment strategies, probably most notably active versus passive. Most passive or index funds carry no revenue sharing payments. Expenses are very low. There is no offset being made to a record-keeping service provider for holding an S&P 500 index fund that you may only be paying 5 basis points for, versus the decision to own an active fund within the large cap space, where you may see revenue sharing payments from 5 to 25 to as much as 0.4% of total assets. So significant revenue sharing payments. And I think we have to be leery, certainly from a portfolio construction, to having things like revenue sharing payments dictate the types of investment products that we provide to participants within a plan. That would be a high-risk area as it relates to potential litigation going forward. And the next is share class selection. You know, I call out an organization like American Funds, which may have as many as 8 different share classes. So whether you use an R6, which would have no revenue sharing, or you use a lower revenue sharing class, which would provide more revenue sharing offset, the share classes that you use at any service provider are going to vary dramatically the amount of expense that's being paid by the participant, and therefore the offset that may be provided to the record-keeping service provider. The challenge with that is that some participants will pay more and some will pay less. If I'm an index provider and I only own the S&P 500 and the Barclays Aggregate Bond Index, my portfolio holdings may provide 0 revenue sharing back to offset record keeping and administration expenses. If I'm an active investor that has an active small cap growth mandate and emerging markets and an international value mandate, maybe the weighted average of my revenue sharing is as high as 0.3 or 0.4%. So my 0.3 or 0.4 is subsidizing effectively other participants in the plan who may not be carrying that additional expense. And the subsidy is important because certainly the net return that we all achieve is a byproduct of our expense. So any additional expenses, whether they're investment management expenses or whether they're revenue sharing payments that are being made to the record keeper, help bring those expenses down. So it is not a process that has no impact. It has a very direct and quantifiable impact on participants. So here's a quick fee equalization example that we went through in our 2014 white paper. You know, let's assume you're working with a service provider. Their revenue requirement is 0.20%. And let's say I've got a very simple 3-tier or 3 investment product menu. So, you know, under the kind of the old style menu, I might have a stock fund that has an expense ratio of under 1, but of that 0.98, 0.40 of it is revenue sharing. I might have a money market fund with a 0.42 expense. 0.2 of that is revenue sharing. And I might have a bond fund that's at 0.46. It only provides revenue sharing of 0.03. So you'll see that some people, a stock fund holder in this example, are paying more than the revenue requirement. The money market participant is paying exactly the revenue requirement, and the bond fund participant is paying less than the revenue requirement. Under a fee equalization model, what we say is, well, everybody should be subsidizing or paying their fair share of that 0.20%. So in a fee equalization model, what ends up happening is the stock fund participant actually gets a credit. So their 0.4 is they're getting additional credits to the tune of 0.20%. So their cost of ownership actually declines from 0.98 to 0.78. However, the bond fund participant who had previously only been paying 0.46% sees an increase or additional wrap on their investment product of 0.17, so their actual cost of ownership increases to 0.63%. So everyone in this example is locked in at that 0.20%, but you'll see that some folks are paying more than they were in the pre-model, and some are paying less than they were in the pre-model. Which kind of gets us to the pros and cons, right? You know, the pro of fee equalization is that it does create, at least for some plan sponsors who use this as a metric, it creates some equity in that at least all participants are paying the same percentage of their assets for record keeping, administration, employee communication services, for which all participants benefit theoretically. Investment products that need to be changed are not complicated by revenue requirements. You know, if you go back to the previous example, if stock fund A is underperforming in this very simple 3-portfolio model, then ultimately you have a challenge, because if you are going to maintain a model that gets you back to that 0.20%, you're going to have to find a revenue, a product, a like product that also shares a lot of revenue, which means ultimately it shrinks the number of investment products you have to select from. Or worse yet, maybe a committee overlooks or neglects to be critical of a product like Stock Fund A because they recognize that taking it out would have an economic impact on their pricing model, both of which are disadvantageous. So the notion that investment products can be replaced without disrupting the fee payment process or the economic process certainly is an attractive one. There are some complications to it, though. Probably first and foremost is that the transition from pre to post can be challenging. In that, by the previous example, in almost all cases, some people will end up paying more than they were the day before, and some participants will pay less. The participants paying less, clearly it'll be easy for them. Those who are paying more, index investors or others who are very, very focused on expenses, may find this to be less compelling, certainly for them personally, even if it's compelling for the plan as a whole. I also think it complicates the 404A5 disclosures. Certainly, we have clients who utilize this methodology, but you're looking at varying levels of RAP, and in some cases even a negative RAP expense, as I pointed out in that stock fund case, where you've got a more complicated disclosure than most 404A5 disclosures, which is here's just a list of your funds and their expense ratio. It frequently requires, to do it well, the quote-unquote unitization of mutual fund investments. So if I'm charging an additional RAP, if I'm trying to assess that RAP each day, what's going to end up happening is I need to create units of Stock Fund A. And for those who are tracking the performance of their account in outside financial software, that unitization process will create a disruption between share price and unit price, which is difficult for participants to wrap their mind around. And it's certainly complicated from a record keeper perspective, right? Creating units of mutual funds that are already unitized by the mutual fund company adds yet another step. Certainly it creates possibilities for errors on a calculation and computation perspective. All of those things increase the likelihood that there could be an error on the record keeping side. The other big change we've seen, certainly with this huge run-up in the stock market coming out of the 2008 crash, is a look at per capita structures. From my perspective, record-keeping administration have a very, very low correlation to growth in plan assets. We're seeing a baby boom generation in many cases has increased relatively dramatically the amount of money that they're putting in on an annual basis. Clearly, stock market performance, at least for the last several years, has been significantly impactful. None of those things made the retirement plan more difficult. Actually, I could probably make an argument that when the stock market goes down, these plans become significantly more expensive in that clients need far more employee education, far more hand-to-hand work with clients to address the impacts associated with significant market declines. So having assets and revenues be correlated is very much not in line with workload. And again, you can look from January 1st, 2009 through September 30th of 2014. The S&P 500 index was up 150%. Clearly, if you had an asset-based model on 2009, you had no contributions, no distributions from 2014, and you haven't renegotiated your asset structure, the vendor who's providing exactly the same set of services has seen a 150% increase in their revenue associated with your account. Again, a period of time where inflation has been about 1% or maybe 1.5%. We haven't seen huge participant growth. We certainly have seen a reduction in unemployment. There's always some transitive growth in plans from a participant population, but unless you're an explosive growth type organization, those increases in plan participation are far, far more muted than the volatility associated with tying revenues directly to plan assets. So the mechanics of typically of a per capita structure is to try and A, reduce all investment products to their lowest cost share class. Because if you're going to have a per head fee, having lots of revenue sharing also in the system, again, creates some of the fee equity challenges that I talked about previously. So preferably if you can find products with no revenue sharing, that's great, because then you can get down to a strict per capita expense, again, whether it's paid by the plan or whether it's paid by the plan sponsor, either of which is workable. You negotiate a per capita fee structure with your service provider, and you're able then to either pass those expenses along or have them paid at the plan participant level. This is most advantageous for large average account balance plans because in those large average account balance plans, having fees that might be somewhere between $40 and $150 per account holding participant, depending on the size of your plan, those fees are small in comparison to an asset-based fee on a six-figure account balance. So if you're a $150,000 account holder, a 10 basis point fee gets you back to that 150 level. So large average account balances tend to favor per capita pricing. The pros of the per capita model is, again, it creates that fee equity in that all participants, in this case, pay the same dollar amount for plan services. In the prior example, they paid the same asset-based fee. And I think that plan sponsors can and do differ dramatically about which of those two metrics they consider to be most fair, whether some combination of them should be fair. But again, it creates equity in that, at least in this example, they're all paying the same dollar amount. It's highly transparent and certainly easy for participants to understand. If the model is you, a participant, for having this account where we make contributions as the employer and you have the ability as the employee to make contributions, will cost $100 a year. It's $25 at the start of every quarter. It is very simple. May not be appealing from a participant perspective because sometimes fees you see are thought of more critically than those they don't see, but it's certainly easy to see and easy to understand. Investment products that need to be changed or swapped out are, again, not complicated by these revenue vendor requirements that I talked about. So when Fund A needs to be replaced, you have the unlimited universe of available products to review as a substitute rather than those that may provide the requisite level of revenue sharing necessary. And importantly, fee escalation becomes decoupled from investment performance. The downside of that clearly is if markets go down, your expenses will not go down. Your participant count, if it stays the same, and likely increases because people retire, you hire new folks, and the folks who retire don't necessarily leave the plan, but your fee escalation is decoupled from investment performance. Again, the cons always come to transition. I think that plan sponsors are reticent to disrupt participants who seem happy with what they have. So having to go through the process of saying you didn't see a fee before, but now there is a fee, and here it is, even if that fee is less than what they were paying in asset-based fees previously, the communication of that can be challenging. And pricing volatility for low average account balance plans with high turnover certainly makes it less attractive. I think of the retail space specifically, where we can see large volumes of clients being hired, auto enrollment in some cases being utilized, where you're getting huge numbers of de minimis account balances and having to pay a fee for each one of those accounts can be challenging. So you could have someone who's auto-enrolled, they put $75 in over the course of a month and then leave. Now you're paying $80 for a $75 account. Not attractive. You have to figure out ways to manage that process. Certainly you have the ability to auto-distribute those with de minimis account balances, but that process typically only happens annually. So if you're going to go to this type of model for those, again, high volume, low average account balance plans, you may have to go to a more frequent methodology for having those accounts distributed. And again, that correlates to the next issue, which can be a potential obstacle to enrollment for participants with low wages or low average account balances. So if you're an institution who's kind of worried about the social justice message, if your plan has a participant expense of $100 a year, which in many cases is very, very reasonable depending on the size of the plan, telling a participant who makes $30,000 a year and who's thinking of deferring 3% of pay into the plan, that they're going to have to pay $100 for what over the course of a year will be a $900 account balance, not very attractive. There are methods by which you can deal with that. In some cases, I've seen sponsors pay participant expenses on account balances under a certain size. I've seen mixes of asset-based and per capita type expense methodologies, but it's certainly something to think about is, are we discouraging those who are really typically in many defined contribution plans we're trying to get engaged in the plan? Are we discouraging them from participating by creating a high hurdle from a cost perspective to enrollment? I'll say on the vendor side, there's certainly a couple of things that we've seen that are pretty impactful, and maybe the one that was most notable in 2014 was based on the fee compression and the change really in many cases from asset-based pricing to per capita pricing. Those changes have reduced pretty significantly the upside. The notion of getting retained as a service provider at 0.20% back in 2009, and that plan assets may triple, and I'm still getting my 0.20%, I think that the actuaries who have looked at cost structure changes over time have determined that that unlimited upside is much more limited than it had been. And as a result, I think service providers are less apt, less willing to provide extra services without extra cost. So we have seen a significant uptick in project fees for fund changes, project fees for plan amendments, project fees for customization of education materials, all of the things that are certainly outside the normal workload of processing contributions, distributions, and transactions every day have increasingly become subject to an expense. I don't necessarily think that's a bad thing. Again, I think the degree to which you can have a high correlation between effort and compensation, the better I think plans operate. But I think that many plan sponsors have been surprised to start receiving those because they haven't perhaps in years prior. We also have seen an uptick, which had been a downward trend for a long time, but an uptick in these participant fees, which plan sponsors traditionally are less focused on. In some cases, this is an area of debate, but in many cases, these are just thought of as being the fees. So whether it's loan fees, hardship withdrawal fees, QDRO fees, or qualified domestic relation order fees, distribution fees, all of those seem to be on the uptick. Many of them are being paid by plan participants, and as a result, plan sponsors aren't focused on them. But again, they're infrequent. In most plans that aren't high transaction, they're infrequent, although we continue to see an escalation in loan activity. But in general, these fees are infrequent, and even if they're being increased, tend to be a low percentage of the total cost of operating a plan. And then the one that I find most interesting really has to do with the vendor focus on alternative revenue streams. Earlier, actually it was late last year, there was a good piece from one of the research pieces of the Federal Reserve Board that looked at defined contribution plans. And what they noted was that for many plans, the affiliated funds, so if I'm a record keeper and I'm selling my own funds, plans tended to exhibit a higher degree of affiliated funds within their menu, and the rate at which those funds were removed seemed to be lower independent of their performance record, meaning that once they got them in, which they were successful in doing, they were able to keep them in regardless of whether they continued to perform well or perhaps they perform more poorly. So on focusing on the alternative revenue streams, maybe one of the biggest is proprietary asset management. It is unmistakable, the Department of Labor is very worried about it, that there is a high correlation between the utilization of target date funds that are related to the record-keeping service provider. And you can look in the upper chart there. That's the growth of target date mutual funds from 2002 to 2013. Depending on who you ask, this may be the largest asset class, already is in some plans, but could overwhelmingly be the largest asset class across all defined contribution marketplaces in the next 5 years based on heavy utilization. So if I, as a record keeper and having an investment management group with target date funds, is looking to get those utilized, the best, most effective way to do that continues to be by providing record-keeping administration services. It's high margin work, low transaction activity, low expectations from participants for communication, therefore a very attractive high margin revenue opportunity. But proprietary asset management is not the only one. I think there's certainly 3 others that I would throw into this alternative revenue stream concept as being opportunities in areas where record-keeping service providers are looking for the opportunity to provide additional services that generate additional revenues. And again, as long as they're providing good services and you're getting what you want, I don't think that's a bad thing. But it is a critical part of the business strategy. I'd say one of those is general account offerings on cash alternatives. So with money market rates, many investment products on the money market side have a 5-year return of 0.00%. So we are seeing significant decline in the utilization of money market alternatives. And in place of those, we're seeing general account fixed annuity GIC, stable value products as being the cash equivalent. So if I'm on the insurance side, certainly providing record-keeping services allows me typically to use my own general account as the cash alternative to money market in this case. And for at least general account offerings, one of the beauties is, unlike every other investment product, these general account fixed annuities have no stated expense ratio. They provide a guaranteed rate of return, and they get to keep the differential between what they achieve in returns on their general account and what they credit out in earnings to participant accounts. So there's almost no scrutiny, obviously, of the expense because there's no way to scrutinize it. It becomes a matter of scrutinizing credit risk, return, and is that competitive given the other alternatives that are out there in the marketplace. General accounts also typically have the other benefit of having liquidity restrictions. So if I, as a record keeper, are using my own general account, those general accounts have anywhere from a 1 to as long as maybe 8 or 9 year liquidity restriction. It makes it less likely that the client is going to fire me as a service provider because doing so means a very sloppy transaction and transition, as I need to wait a period of a year to many years to get all of my assets out of provider A and into provider B. So as a result, those cases are more sticky, and it frankly reduces their pricing leverage as well. If I can't leave and take all my money with me tomorrow, it makes it more difficult for me to renegotiate my price with my incumbent provider. The other, we've seen a huge uptick in the push of these managed account programs. So, you know, if you go back, the utilization of target date funds, it's very, very clear that the market, at least from a participant perspective, is spoken. And participants are saying, I would like someone else to manage this money for me. What we have seen an uptick in the desire to use, at least from a service provider perspective, are managed account programs. So unlike target date funds, managed account programs typically take your core investment lineup and then create custom portfolios for participants based on their time horizon and their risk tolerance. So they use a very mechanical, mathematical methodology to say how much in equities, how much in fixed income, when do I need to rebalance that. But it's an automated process that's done either by a managed account service provider or internally within the record keeper. The beauty of these types of programs for a vendor is that they have materially higher net margins. So a target date fund, let's say target date funds have an expense ratio of 0.6 or 0.7%. That's the total cost. Typically in a managed account program, you have the expense of all the investment products plus an additional charge for the managed account solution that may be as much as 0.6 or 0.7%. So it's a significantly more expensive solution, providing more customization than a target date fund, but more revenue back in many cases to the record-keeping service provider. Additionally, it provides a high opportunity for outside account consolidation opportunities. So if I'm using a managed account program as a service provider and you have a 401k at 3 other places and an IRA account, if you want a comprehensive solution, the best way to do that would be to consolidate your accounts, therefore increasing the asset base and creating a better chance that when they retire, they're going to keep all their money within that solution because they've grown accustomed to the managed account solution. So again, stickiness of account dollars, higher revenue opportunities for the service provider. And then the last, and I think the one that has the most work still, is on the decumulation side. So we've seen a huge proliferation of products out there that try and guarantee income. So in a defined contribution setting, how do I make sure that I don't outlive my income? And that issue was hotter in 2009, 2010 when markets are strong. That issue tends to get less attention. But the service providers are very, very focused on it because markets will certainly come back down again. And when you look at it, again, they have guaranteed income solutions, which means they incorporate some level of insurance product, much higher product margins on the annuity side than there is on the record-keeping side. And again, the higher retention of rollovers and the higher retention of plan assets. Because once you have offered a decumulation or a guaranteed income product to participants and participants start using it, it's very difficult to, again, transition away from record keeper A to record keeper B if that negates in any way the guarantees that were made that the participant has been paying for some period of time. So again, reduces the amount of leverage plan sponsors have, increases margins, but all 4 of these, proprietary investment management, general account offerings, managed account programs, and decumulation, all huge issues. And all of them in some way, form, or fashion are really tied to the issue of we have a baby boom generation who by and large is still in the marketplace, but in an increasing rate is coming out of qualified retirement plans. And those 27 service providers that I mentioned earlier who are still providing record-keeping administration services are as much focused on retaining those dollars post their retirement plan experience as they are on their retirement plan product as a whole. So I'll talk about a few next steps. Going back to the previous chart, certainly understanding how much, who gets paid, how is it calculated, is it direct, is it indirect, whether it's through your 408B2s, your 404A5s, or just taking that map that I provided earlier and writing in the names of the people and how they get compensated. Understanding it creates the most ability to make modifications that may make sense to the plan as a whole. Develop a fee policy statement. I think it's important to have a philosophy. How do we want to pay expenses? What do we think is fair and reasonable? How do we mechanically get there? And what methodology are we going to use to continually assess how fair and reasonable that is? But no different than an investment policy statement, having a philosophy, having a method to review and ensure that the expenses, especially those being paid by the plan participants, are fair and reasonable is a critical obligation of ERISA, and therefore for all the plan sponsors out there on the governmental side who are using ERISA as their guide to maintain a strong foothold from a fiduciary perspective. Negotiate with your service providers. Understand what their capabilities are. Service providers continue to be reticent to discuss fees because to discuss fees creates the opportunity for clients to be confused, angry, agitated, whatever the issue is. So service providers in general are reticent to come in and talk fees. Many have very good fee disclosure programs. Many come in and have those conversations. But if you haven't, understand that you have an opportunity to bridge your philosophy with where you may be today. The reality continues to be from the service provider side that search activity has been low. Consolidation has led to more clients who are happier with their service provider experience. Fee compression means that there's less plans that are wildly outside what would be considered reasonable. There's been less search activity, which means that the service providers that are left in the marketplace are more and more eager to try and take market share and win business. And therefore, clients have more fee leverage today than they certainly have had at any time that I can remember. Even if you don't want to go through the search process, understand the capabilities of your service provider and how you can use their capabilities to match your specific philosophy. And if you can't get there, go to search. Again, there's a number of good service providers out there. Many can provide the type of structure that you may be looking for as it relates to the management of your fees and expenses. So that's what I wanted to cover today. I did get some questions over the course of the presentation. The first one, is the revenue sharing percentage the same as the 12B1 fee? So going back to slide 9, where I showed that 0.40%, is that revenue sharing the 12B1 fee? In some cases it is. So the 12B1 fee is one component of revenue sharing. Others have what are called sub-transfer agency fees. And some, frankly, just negotiate a revenue sharing or service offset. So 12B1 fee is not the only method of revenue sharing, and frequently it is one of multiple methods, although there are some, not many, but some where the 12B1 is the exclusive and only form of revenue sharing. If we want to maintain an active tier of investments, how large is the universe of non-revenue sharing options? This does seem important in a shift to a per capita fee sharing model, and I would agree. The good news is the proliferation of zero rev products has been pretty significant. I think if I were to go back to the early 2000s, we saw a proliferation of more expensive share classes. So expenses that had higher amounts of revenue sharing to pay for record keeping administration expenses that the plan sponsor, in many cases understandably, didn't want to pay for. I would say that since 2009, we've seen a broader proliferation of now what I'll call institutional share classes. So a number of products in the last year for clients that have been using per capita models, we've been having to do share class changes to get to the least expensive share class because there's been new launches of institutional share classes, and I think that'll continue. I think that the trend, frankly, is toward zero rev share products and more direct and straightforward fee payments. So I would expect that that would continue, and that therefore the pool of available alternatives will continue to increase. And then, do you find that annuity providers have similar pricing, or are there significant differences? There are very, very significant differences. So on the annuity service provider side, what you traditionally have, especially if you're a large plan, is the ability to go out and get a custom type of offer arrangement from your annuity provider. So what type of rate guarantee are you going to provide? And then frequently they'll say, and does that rate guarantee include any revenue sharing offset to a record keeper or administrator? So that's simple enough if you're using an outside annuity firm. So I'm using Joe's TPA shop who has no financial products, and then I go to the insurance marketplace and insurer A says they'll provide a 20 basis point offset, and B will 15, and C 10. That's a clear arrangement. It's a little less clear if I go to insurance provider A, who only offers insurance providers A's fixed annuity products. At that point, the amount of transparency obviously declines pretty significantly, and what I'm left having to do is look at crediting rates, liquidity provisions, and credit quality as being kind of the three primary mechanics. So it doesn't get to a very simplistic cost versus cost. It's a multi-factor qualitative model that ends up driving the selection process rather than a more simple cost perspective. Are some of the remaining 26 vendors more focused on smaller plans versus the GMs of the world, General Motors of the world? Can we get that information when we are ready to go out with RFPs? So absolutely. So there are definitely, and I actually think there's been a proliferation of this as well, which is that the fee compression that I talk about earlier, that the 18% fee compression that we've seen over the course of the last 4 to 5 years has significantly benefited, and it's been more acute in the higher end. So the 18 is the average across all plan sizes. The decline in prices has been more significant than that for larger plans, and it's been less significant than that for smaller plans. And the reason being that many small plans are taken on at cost or maybe even at a short loss in hopes that they will grow over time. So many of the things I've talked about, per capita pricing, for instance, is much less prevalent in the small market because average account balances haven't had a chance to grow yet. So as a result, some of the ability to grow revenue as the client grows is more attractive on the small plan side. A lot of the customization goes away on the small plan side. So there are service providers who are focused there because it's less fee sensitive. That's not to mean that they're out to gouge smaller plans, but it is less fee sensitive. They are under less pressure to customize constantly, and as a result, it is a more streamlined administrative practice. So, I think that's what you'll find is that you have seen some providers who are focused significantly on trying to grow that portion of their business. And it creates a huge, the whole small plan, large plan issue continues to be one that creates a challenge for the private system. So the private pension system as it exists today is very, very efficient and I think works well in the mid to large plan market where you have sponsors with the resources and the scale to drive down the cost of providing investment products to participants. Where it continues to be a challenge is on the small plan side and on the micro plan side where you see no plan adoption at all, but even on the small plan side where the cost of investing continues to be high. So if we can't, as an industry, arrive at some level of pricing efficiency for those small plans, we will be in a position where at some point, whether it's at the state level, state of Oregon certainly is working on trying to assemble an alternative to a private pension system for small plans, or whether it's at the federal level where those small plans are going to end up having a different type of solution. Because so far, while there are providers who work there, unfortunately it's an inefficient market. It seems to be driven tremendously by brokers. And if the memo from the White House is accurate or within the White House is accurate, those cost structures tend to be higher when brokers are associated with them. Well, I think that is all the questions I have for today. I really appreciate everybody attending. Again, if you have a question that pops up after today's presentation, don't hesitate to send those along via email. My email information is certainly on the website, or feel free to give us a call. I'll be happy to send those out. Again, keep your eye out for an email with the materials. And again, usually within about a week, we'll have this posted to the website as a recorded webinar if you want to go back and see if whether I flubbed my lines at some point during today's presentation.